how can retirees take advantage of the 0% long-term capital gains rate? In today's video, we're going to talk about the unique tax rates that apply to long-term capital gains. We're going to talk specifically about that 0% number, how it applies to retirees, why it's a unique opportunity for retirees, in particular in the early stages of retirement. And then lastly, I'm going to give you a few ideas how you can get the most benefit out of that 0% bracket. Okay, so let's get started. What exactly are long-term capital gains? How do I get long-term capital gains? Well, just use a stock as an example. If you hold a stock or a mutual fund or an ETF, you buy it for $1 and you hold it for a year or longer. When you sell it, if there's gains, those move from short-term capital gains to long-term capital gains. So as a general rule, now as we go through this video, keep in mind this is going to be very high level. So get with your financial advisor, get with your CPA, hopefully even together, that's better, and work out a plan specific to you. But in general, when you're holding an asset for longer than 12 months, it moves from short-term capital gains to long-term capital gains, which has its own unique tax brackets. And they're better typically than short-term capital gains. So let's look at this bracket. So when I've owned assets for longer than a year and I get long-term capital gains rates, if I am married filing jointly, under $94,050, I'm paying 0% on those gains. If I'm single, it's half that. It's around $47,000. Okay? So what exactly does this mean? This looks at my taxable income. And let's just use married filing jointly as an example. If my taxable income is lower than $94,000, the long-term capital gains portion of that is going to be at 0%. Now, an important piece to think about here is this taxable income, this is going to include any ordinary income. So if you have bond income, if you start taking Social Security, if you have a job, any of those things are going to count towards that $94,000. And so this is why, as we discussed earlier, that it's unique to retirees that may be able to fully take advantage of this 0% tax bracket. Because while before retirement, they might have been in their peak earning years, now, after retirement, you find yourself no longer with the same wages you had before. Your income has dropped. And you've gone from having an employer or a business to now looking at your portfolio and figuring out how do you want to generate your paycheck in retirement, which could come from your IRAs, it could come from your taxable accounts, you could turn on Social Security. So you have a lot of flexibility here, and with flexibility and those choices comes opportunity. And so again, when you're getting with your team, you should be looking and saying, are we taking advantage of all the opportunities that are available to me, and what are the decisions that I should make in order to maximize those opportunities? So let's talk about some of those decisions to think through to potentially maximize that 0% tax bracket. And so if our goal is to maximize the 0% tax bracket, what we want to do is make sure that we don't have a whole lot of extra income coming in that's going to push us up, which gives us less room to fill up the bracket. So how can we keep our other income lower? Well, early in retirement, sometimes the question is, should I take Social Security early? Now, just looking at it in a vacuum here, I know there are other considerations. We've talked about this in other videos around timing of Social Security, but this could be a reason that you want to delay taking Social Security, because that is those dollars that you're collecting in Social Security, a portion of those is going to start to fill up that bucket, which is going to give you less room for capital gains. So potentially delaying Social Security. Another thing, when you're looking at your taxable accounts, if you have a lot of investments that are kicking off income from those accounts, you may want to think about putting those inside of an IRA where it's not going to generate as much income, and you have more flexibility inside of your taxable accounts when you want to generate income and how you want that income to be taxed. And another is, if you're later in retirement and you're looking at required minimum distributions, right, that can be a challenge because that is going to be an issue that's going to, again, count towards that bracket. And so your early years of retirement, before your required minimum distributions kick in, is going to be your biggest window to capture as much at 0% as possible and remove some of that uncertainty around your future tax bracket in retirement. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.